Yeah, well, 2023 is setting up to be a pretty good year for crypto assets after last year's 64% plunge. In January alone, Bitcoin is heading to a roughly 40% gain.
I think earnings have been discounted in prices. I know the bottoms up guys say, well, this is not right. And almost everybody on Twitter says that. I keep asking the poll. Everybody's still very bearish. All of the sentiment indicators everyone's maximum bearish. And I, using my macro framework I've been using for 18 years, I just don't think that's the case.
Hello and welcome to Wealthy Value. If you're not yet subscribed, please go ahead and do that, and we promise to keep giving you quality market analysis. In today's video, we evaluate the reaction of macroeconomist Raoul Pal as he responds to current trends in the market. Crypto is up and the stock market is also on a rebound. Can this rally be sustained? Let's listen to what he says about this.
I'm very bullish risk, bullish crypto, bullish technology, bullish carbon credits, bullish bonds, bullish gold, don't really have any of it. Starting to wait for things like copper because we've got some secular backdrops. I like secular trends. I don't tend to trade the cyclical stuff anymore. I find it a bit boring, and I don't think it's very easy to make money consistently over time. I like a secular trend, and when, for example, when you look at the technology stocks like, we can take the NASDAQ. If we take the NASDAQ on a log chart, we've come back to the bottom of the log trend channel, and we've had all of the bottom indicators and signals. And usually if you can buy the cyclical sell-off when it hits the secular trend, that is the sweet spot. We're in that sweet spot now. We're in the sweet spot in crypto, technology. We will get there probably in copper as well. And a few other markets where it starts to get very, very interesting for very high future expected returns. We saw something not dissimilar in carbon as well. So that's where we are. Cyclical pressures down to the secular trend. I love my secular trends. My big secular trends are India, technology, exponential age technology. That's a whole host of things, from robotics to AI to EV to distributed data to metaverse. All sorts of things come in that bucket, and I've been writing quite a lot about that over the last few years. Exponential age is the other big theme. Stuff like, I like the Middle East, and maybe Saudi Arabia is the one harder to trade, but I think it's really interesting. I'm bullish on copper, as I said, carbon for those reasons as well. And then crypto is the bigger bet for me because I think it has a higher expected return. Comes with more volatility, but I'm happy to stomach the volatility because I've got an income, thank God. And so that means I can allow the volatility in my portfolio moving around because I've got money coming in. But if you're trying to live off crypto, it's bloody difficult because it goes up and down a lot. So anyway, so that's where we are.
So he thinks inflation goes negative this year. In 2018, the year ended with a Fed interest rate of 2.25 to 2.50. The last rate was 25 basis points, just as we had the Fed's last rates, but this time we seem headed for a rate ceiling of over 5%, which is double what we had in 2018. So we begin to ask, is this rate not a little too high? It should be recalled that by 2019, the Federal Reserve admitted that the rate hike was a mistake. Realizing they'd overhiked the rates, they had to cut the rate from 1.5% to 1.75%. Which was a major cut in rates. By March 2020, the Fed rates were already cut to zero. Would that happen this year? Do we need the Fed to pivot like it did in 2019? Raoul Pal gives us more forecasts.
We are hurtling off the edge of the cliff into a recession. That recession we've been forecasting, Julian Bittle and myself at Global Macro Investor, from about this time last year, actually. We saw it in the forward-looking data, and the current data is catching up. So we're now, I use the business, the ISM as probably my best guide to the business cycle. And that's kind of at this 48 or so level, 47 point whatever level. And really just below 47 is 100% chance of recession. Now, all the forward-looking indicators like new orders are completely off a cliff. Employment, prices paid, you name it, every single indicator. We have a database of 1,500 indicators at Global Macro Investor, and it's all falling off a cliff. So this is the point where you get to on Twitter where everyone goes, oh my God, there's a recession. Surely stocks are going to go down. No shit, Sherlock. They've already gone down. The NASDAQ went down 37.7%, I think, from the high. But what's interesting is that the forward-looking indicators are starting to suggest that we will hit the bottom of the recessionary wave in about April. So we're likely to get, I think, 2, maybe 3 quarters of negative GDP. But I think it's more akin to the 1990 style recession, which was the stock market fell 20%, the economy fell 2%, ISM went down to 40 or so. It all recovered. There was some overhang. The economy was slow for a while and then eventually recovered. A normal garden recession. That's what I think we're in the middle of. I think people are confusing prices, which is the unwind of the prices as in markets, the unwind of everything that happened in 2021 got unwound in 2022. And I saw Dario Perkins on Twitter calling it the A-shaped economy. So as opposed to a V shape, it was an A shape. So it went up, came back down, and it's reverted back to trend. So almost all of the charts have reverted back to trend. I think oil still got a bit of a way to go. Nat gas got there. Most of the commodities have got there. Most of these things are down 30, 40, 50, 60, 70% now, taking the inflation fears out.
Indeed, it seems investors are getting tired of the bearish sentiment. This could be the reason why the markets have stopped reacting to the macroeconomic conditions and restrictive fiscal policies. Raoul Pal thinks that the bottom is only about 2 months away, but it seems near indeed. The S&P 500 is up by 1% and Meta is leading the pack. Meta has surged by 23%, which is the biggest gain the company has had since 2013. Other big tech companies also seem set for huge gains, as we're beginning to see some action on the stock prices of Alphabet, Amazon, and Apple. The Nasdaq component did even better, because it was also up by 3.25% at the close of January. But the best performing asset for January is Bitcoin, which is currently up by 40% and seems poised to break the 25,000 resistance price. So we wait to see if this is going to happen. So back to the big question. Is the market pricing in the possibility of a recession?
This recessionary thing is what's in everybody's head. And the narrative in the market is, well, just wait for the earnings leg. Do you not remember 2001? Do you not remember the second leg in 2008? Those were very different styles of recession to that, in my view. Of course, I could be wrong. My guess is when I look at the rate of change of the S&P or the Nasdaq, they've all entirely priced in a recession. So the Nasdaq priced in an ISM of about 37, which is where my forward-looking indicator, my Global Macro Investor Financial Conditions Index, has been pricing the bottom of the ISM trough. And it's all coming around the same date. So what's happened is the markets have been forward-looking. They discounted the recession fast, and they're now starting to discount the pickup on the other side. And that's coinciding with the rate of change of Fed increases coming down. The ECB are the same, the Bank of England are the same. Everybody's slowing down their rate increases and are going to pause mode. Whether we get one more hike or not, I doubt it actually, but there's a chance we get one more pause. The bond market's starting to realize that that's probably the case as well. Also, global liquidity, M2 cycle, stuff like that, that's been picking up. It started with China, and it's going to start resonating throughout the world. Things like the falling dollar, falling commodity prices start picking up this kind of rate of change of liquidity. That also suggests that we kind of are bottoming around these levels. So we've got global liquidity bottoming. We've got the rate of change of interest rates that's taking the pressure off the neck. You know, Jay Powell's had his foot on the neck of the markets and the economy. So he takes his foot off, things can rise again.
The Institute for Supply Management, or ISM, reported a decline in its Manufacturing Purchasing Managers Index, or PMI, from 48.4 in December to 47.4 in January, indicating a contraction in the manufacturing sector. This was lower than the expected reading of 48.0. The New Orders Index dropped from 45.1 to 42.5, and the Production Index decreased from 48.6 to 48.0. Although the Employment Index decreased from 50.8 to 50.6, it remained above 50, which means that job growth in the manufacturing sector is still ongoing. This is a very clear sign of the economy slipping into a recession, but would likely be a mild one and not as severe as many analysts had previously expected. The falling ISM index is indicative of a falling GDP, but Raoul Pal is confident that the market would not crash any further because they've priced in the possibility of a recession. But what do you guys think? Let us know in the comment section below. If you enjoyed this video, be sure to give it a thumbs up and subscribe for more. Thanks for watching, and we'll see you in the next video.